Okay, good morning, everybody. Mark Whistler here, and good morning, everybody with FX Street. I just want to make sure everybody can hear me okay. I apologize profusely for being late this morning. Technology issues. A little bit under the weather, but I really apologize. Your time is very valuable, and I apologize for being late. Um, of course, I am more than happy to go a little bit long on the backside if we need to. No problem at all. Um, so, however we can compensate. Thank you so much, FX Street. I apologize for the headache this morning. And thank you, everybody here, for being here. I'm really excited about today's webinar. I probably have put in a pretty darn close to about 500 hours on some of the information that you're going to see today. And the monthly webinar today is on using descriptive statistics and probability to begin to understand a little bit more of how to perceive larger movements within Forex. And we have actually two sections to the webinar today. The first section, of course, is to review part one of the special report, which you already should have and should be available on the website. And the second half, Ed, let me just double check that and make sure we have everything here. How's that? Is that, Ed, are you able to see the whole? You should have the first part, which should be of the report of descriptive statistics, which should be available. And I will just pull that up on the screen here, just so you can see what it looks like. And then this is part one of the special report perceiving Forex volatility through descriptive statistics. And then, of course, part two we will unfold in the second half of the sessions. I highly encourage everybody to do that. And then, of course, the entire part two will be available on FX Street as well. I'm going to actually, as I was sitting here last night at about 4 in the morning, I was trading, and I was looking over the second half of the report, and I realized I think the best thing for us to do, instead of actually just giving you that report right now, is to actually incorporate some of the information and the charts that we use today in the second half of that report. That way, when you go back and review the report after this webinar, then you'll remember the information that is in that report, because we'll have actually walked through those specific charts in real time. And what is so, I think, brilliant about some of the information that you're about to receive is, A, it's not really information that is generally out in the mainstream public of trading or the market. And while it is and has been around for a long time, not any individual retail traders, not very many retail traders actually use it. And so, is that a little better as far as the microphone goes, Mon? What we're actually going to see here is that descriptive statistics are not complicated, and they are incredibly applicable to FX markets, along with equity markets and obviously indices and ETFs as well. So the information that you're going to receive today not only applies to Forex, but it applies to all things equity markets, option markets, stock markets, or excuse me, Forex markets, and really should give you a significant edge in the rest of your career. And part of the reason for that is that a lot of what we already have out there in the market is really just technicals and fundamentals, and a typical paradigm of utilizing lagging events to perceive future occurrences. And the problem is that utilizing those lagging events in terms of technical analysis, the problem is that there tends to be a pretty significant breakdown when obviously those occurrences do not come true. And just out of curiosity, how many people here who um, have ever actually taken a trade and all of a sudden they find that they get stopped out at the exact high print or at the exact low print? Has that ever happened to anybody here? Yes, yes, Jim, Sally, yep, Picnic. I'll tell you what, because if that hasn't happened to you, you probably just haven't been training forex enough. Because I want to tell you a few things. First and foremost, I've been trading for a long time, and it's happened to me plenty of times. And when I first started trading many years ago, it happened all the time. And even more so, at times I would be long currency or I would be short a currency, and the currency would start to go against me, and I would break my rules and, of course, hold the trade a little longer than I should. And not only would I end up being stopped out at the high or the low print, but when I first started trading, I think I probably blew up my account at least 20 times because I was over trading my account in terms of size, but I was also um, just not able to perceive those moments of extended volatility when when all of a sudden forex pair would yank against me, and I would, obviously I was holding way too large of a position, and then all of a sudden my entire account would unwind. And I hate to say this, but if you haven't blown up your account at least once or twice, you're probably not uh, trading Forex enough. And I certainly hope everybody here doesn't go through that. But I know, some of the best traders in the world, it certainly has happened in many cases, probably more than one time. And it's usually those occurrences that really allow us to take a step back and learn from our mistakes, and more than anything, to actually ever to really to learn about discipline and money management. But it was through a lot of those instances, and through those tough times many years ago, that I really begin to dig into my trading and dig into the underlying paradigm of forex. And I kept saying to myself, and this so long ago, and I obviously didn't have as much knowledge and experience as I have now, but I kept saying to myself, whenever I would have these horrible trades, or God forbid, one of those days when my entire account would unwind, but I would say, why am I even bothering with forex? It's so unpredictable. We get these jagged moves that come out of nowhere. The indicators show me that everything is lining up. I'm showing that I just took a position in the euro. I'm trading with the trend short. I got in on a shooting star on the candlestick chart. The daily stochastics are overbought. In fact, and we even just violated support, blah blah blah, and needless to say, all of a sudden we'd hit a huge rally, and of course I would be short every single penny plus every ounce of leverage I could possibly get my hands on, and all of a sudden everything would just come unglued, and obviously so would I. And the most difficult thing about actually blowing up your account, HDN, as you probably know, and HDN, I think that was really bold of you to mention that, and I really hope I really hope that in today's webinar you're able to never have that happen again, and if anything, for HDN, with that type of a blow up, the fact that you're still here, I think says a lot, and I think that you should give yourself a pat on the back, and know that over time everything is going to get better. So Rama, it was a combination of both leverage and being in the wrong trade, and that's that one of the I think one of the toughest things about being a newer trader to forex. And I know that I did this in the beginning, and And even though, at that time, this is way back in the day when I first started trading forex, I I had no problems trading equities or options or obviously even index futures. But the issue is that within leverage, because you're given so much leverage, the problem is that we no I didn't trade for the banks. Yeah, I traded for AIG. No, I'm kidding. I I the problem is because we're giving so much leverage. The issue is that sometimes it's sort of that old just kind of Thanksgiving or holiday adage that our eyes are bigger than our stomach, and we put all of this food on our plate. Metaphorically, just kind of talking about taking on the biggest trade that we possibly can, and then we get about halfway through that plate, and all of a sudden we realize we're so full there's no way we're going to be able to finish. Well, it's the same thing with forex. If we take too big of a position and then all of a sudden the trade starts to move against us, not only can we not think clearly, A, but B, even if we needed leverage to try and wiggle our way out of the position, we wouldn't have it because we're basically just fighting the possibility of being stopped out by the risk management and margin computers. So, but to the over leveraging is a whole other animal within itself, which we're not really going to talk about here today. But the bottom line that I want to mention here is that it was through my experiences and obviously my desire to obviously make huge money in forex, and again, this was back in the day that that I made all of the same mistakes that I would expect most of the people here or most of the newer traders probably make, and again, those are just simply over leveraging your account, one, and two, really just not understanding the larger paradigm of volatility within forex. And when we start to understand the larger paradigm of forex, we really start to see that not only are we able to predict trending, but we also know when trending ends and a reversal will ensue. And the greatest part about this is that I'm sure for many people here, if you ever catch like a massive large move in one direction or another, or like say all of a sudden you're short the euro US dollar and you catch a big 200 pip down wave. Well, you get to the bottom there, and then all of a sudden it starts to rally back out, and you say, okay, well, I know this is a pullback in the trend. Well, where do I get my short re-entry? And that's exactly where the probability side comes in here, because using descriptive statistics and methods of probability, not only will we be able to identify when that larger trend has ended, but we will also know whether to trade it specifically for reversal or for a trend re-entry, and you're going to see all of that today. So I really am pretty excited about a lot of this information here. And there's some information as we start to get into the indicators and some of the other items. I do have to tell you there's some of the information that I am going to hold back because obviously a little bit of it is proprietary, and I do have some automated systems that I've created around a little bit of this information, and I'm not going to give all of that information away. However, I am going to give away all of the necessary information that you need to do this yourself, and with it, you should be able to generate a significant paradigm shift and a larger change within your forex trading to be way ahead of the curve, and really be able to to profit in forex in the days and months to come. Will I sell for a price? Do you mean the systems, Ed? Yeah, I was thinking about it last night. I was thinking $40 billion. I actually, I have to tell everybody here, my personal goal in forex trading is, and I'm not kidding. This is my personal goal is to, by the time I'm 40 years old, pull $40 billion out of forex markets. And obviously, I'm a long ways away, but we'll see. Anyway, I'll back up for just a moment. My name is Mark Whistler, and I'm a founding principal of Techonomics. It's a small currency hedge fund, and of course a small investment banking firm. I am a senior market strategist at Trading Markets and at Forex Force. And of course, every once in a while, I am on CNBC. That's actually my life goal, Ed, is to make more money than George Soros. And George Soros is one of my greatest heroes. I think that his theories on reflexivity are absolutely brilliant, and I think that he is a brilliant man, and he really called this global meltdown quite a while ago. So he really is. I'd say when George Soros speaks, stop and listen. He really does rule. I think George Soros and John Bollinger. If I could ever like combine two people to make the perfect trading robot, it would be those two guys. Anyway, I have a few books that I've written, and by the way, there's a book on Forex on the way, and hopefully that should be out probably towards the end of. Actually, I was shooting for September, but I think it'll actually be November, and so if you'd like information on that, please give me a call. It's mark@wallstreetrockstar.com. Of course, that will cover plenty of information on probability as well, but even more so how to, on a common sense level, understand the larger paradigm within economics and also within technicals. HDN, I missed Soros' declarations this morning on Credit Crunch. What did he say? Yeah, we'll be charting too. SU. And by the way, what I really hope to do today in this webinar, I know sometimes that in webinars and in any type of market related seminar, they tend to be one way, and what I mean by that is really it's kind of just a speaker listener mentality, and I do not want that to occur today. And please, I respect everybody's opinion here. I think everybody here is a great trader, and I really think that everybody here has something of merit and value to say and insert at any time. So please, I request that this webinar today is an open dialogue, and that you ask me any questions at any time and or make any comments. And please, let's keep this more of an open dialogue where we're really talking and chattering back and forth, rather than me just kind of explaining all of these concepts to you, because I think it's through that open dialogue where you will truly get the most benefit. So what we're going to do today in the webinar, we are first. I'm going to, and this is going to be a little bit of old news for everybody, but it's very important. I'm going to kind of go through the larger economic paradigm, and then we're actually going to move into the explanation of the descriptive statistics, and then for the bulk of the morning webinar, what we're going to actually do is we're going to just start working through the charts. And I'm going to show you exactly how the descriptive statistics show up on each of the charts. And once you begin to see how there is a normal distribution apparent on every single chart within the time frames that we analyze, I think that with that information alone, you should start to see an entire paradigm shift of volatility within your trading. And by that I mean you should start to be able to perceive and see volatility before it occurs. And what's really important here is that, much like, has anybody seen the movie The Matrix, where all of a sudden at the end of the movie he starts to see the code? Great. I think what I really hope is that by the end of part one, you will start to see the code. And what's going to happen here is this is going to cause a little bit of confusion, and I understand this, and I already expect a little bit of resistance from this. And the reason why is because the information that you're about to go through really is information that is a little bit more of a larger paradigm shift than what you're typically used to seeing from most technical and fundamental analysts. And truly, what it is and I'll just move this. This is actually, and you'll receive a copy of this. This will be on FX Street. What you're seeing here on my screen, this is actually part two of the special report, which is not live yet, but you will receive. And I kind of go through and talk about the probability paradigm shift, and really why it's such a big, why it's going to be, I think, a little bit difficult for some traders to comprehend. And I just want to take a moment and we'll read through this to sort of understand exactly why what's happening here. And we're just going to go through and just read through this first part, one paragraph at a time, and just talk about it. And it really it's important for you to know that I understand that these concepts are going to be met with resistance. So I expect questions and I expect comment. But that's because unless you have really traded for an institution or a major FX reserve, or in the case of a major U.S. corporation or global corporation, unless you've traded on their unless you've actually traded on their currency hedging desk, it's doubtful that you would have actually seen these strategies. And the thing is that major FX funds and major currency reserves, they don't trade on charting signals, and maybe there are a few out there that do it, and yeah, the traders look at the information and digest it, and they want to know what's going out there, but they don't trade on Fibonacci retracements, and they don't trade on a MACD crossing above or below. And it's important to know that, and it's important to remember that in every single moment we have to yes, and actually, Rama, I hope to explain everything. So please ask as many questions as possible. And I just want to reiterate to everybody here, this information is going to seem overwhelming and it's going to seem complicated at first, but in essence it's actually very simple. It just because it does have the stigma of descriptive statistics, it is just going to seem a little bit it's going to seem like a little much. But once you kind of get through that moment of unclarity, and once you actually have that aha moment, you are going to, I think, see such a huge, beautiful shift within the way you look at Forex and markets all the way around. And what you're going to understand is that, like I said before, most FX reserves and funds don't trade off of MACD. They don't trade off of just a Fibonacci retracement. They wouldn't be so foolish as to trade millions and billions of dollars on just the simple technical indicators. But at the same time, they also are not so foolish that they would just trade off fundamental perception. And by that, I mean they're not so foolish that they would trade millions and billions of dollars based on of some type of event that has or could occur. And by that, I mean they're not so foolish that all of a sudden they're going to trade billions of dollars based on the notion that the United States is going to raise interest rates 9 months from now. But what they do is they do take that information, the fundamental information of what they think is going to happen, and then they combine it with the technical information, and they overlap it, as John Bollinger pointed out in his book Bollinger on Bollinger Bands, written in 2002. They combine it to create what John Bollinger calls rational analysis, and I actually call it techonomics. It's the mixture of technical analysis and economics. But here's the thing: what funds do is they identify the major FX reserves. They understand the fundamental paradigm behind Forex. They understand what's going to happen on a bigger picture, and then they use the technical side to help identify their entries and exits. And they do use some technical analysis, but for the most part, these guys have equations that are based on volatility and probability to time their entries and exits, knowing that when they take a position, the bulk of the probability data is going to be on their side. And that's why the institutional guys constantly beat up the retail trader, is because the institutional guy understands probability and order flow. And order flow shows up obviously at the most improbable time for the retail trader. And by the way, there's an incredible book that I have that I would like everybody here to read, because I think that it will really make a larger shift in your trading and your trading mentality as well. And I need to just pause for one moment. Okay, I had to just take my headset off for a quick second there. Is the microphone okay? Not too close, not too far. Yeah, it is Bollinger on Bollinger Bands. Believe it or not, Joe. That's really it. And the funny thing is that it really is an amazing book. John Bollinger is kind of one of my market heroes, along with George Soros and a few other incredible traders. And I personally think that book from 2002, every trader should read at least 3 times. I do think that maybe there's some my perception of how the true probability side of Bollinger Bands plays into trading is I think different than John Bollinger's. But that book was written 6 years ago, so perhaps we aren't. Maybe he wasn't even looking at the probability model fully yet, and I don't even know if he is now. Actually, amazingly, I have an appointment to meet him in person and spend some time with him in about 2 weeks. So I'd actually interview him for one of my columns, so I will give you a full report on that as well. I'm interested to just share some concepts with him and see exactly what comes out of that. The book that I would like everybody else to read, so there are 2 books here that I think that are really important to read, and please note that I'm not recommending my own books, because I think that there's lots of good information out there, and John Bollinger's book is incredible, and the other book that I would like everybody here to pick up, it's called The Black Swan. Has anybody ever heard of it? Okay. Actually, you know what I'll do? I'll actually give you the link. In fact, I'll give you the link to both books, and it's important to note that I have no affiliation with either of these authors, and I'm not recommending their book for any monetary gain. I just think that they are absolutely the most incredible book in the entire world. I'll actually read you a little bit of the Black Swan here, and the reason why this book is so incredible and why it kind of comes into play with our monthly webinar here is that here's the book on Amazon. I'm just going to read you a little bit of the of the jacket title here. And what we have to understand, and why also, by the way, if you haven't read George Soros's books as well, The Alchemy of Finance is brilliant. Please read it, and he actually will go into and talk to you a little bit about in that book his concepts on reflexivity. And here's the book, The Black Swan. But let me just read you the inside of the jacket title here. It says, "A Black Swan is a highly improbable event with 3 principal characteristics. It is unpredictable, it carries a massive impact, and after the fact, we concoct an explanation that makes it appear less random and more predictable than it was. The astonishing success of Google was a black swan. So was 9/11. For Nassim Nicholas Taleb, black swans underlie almost everything about our world, from the rise of religions to events in our own personal lives. Why do we not acknowledge the phenomenon of black swans until after they occur? Part of the answer, according to Taleb, is that humans are hardwired to learn specifics when they should be focused on generalities. We concentrate on things we already know and time again fail to take into consideration what we don't know. We are therefore unable to truly estimate opportunities, too vulnerable to the impulse to simplify, narrate, and categorize, and not open enough to rewarding those who can imagine the impossible. For years, Taleb has studied how we fool ourselves into thinking we know more than we actually do. We restrict our thinking to the irrelevant and inconsequential, while large events continue to surprise and shape our world. He goes on to say, now, in this revelatory book, Taleb explains everything we know about what we don't know. He offers surprising, simple tricks for dealing with black swans and benefiting from them. Elegant, startling, and universal in its application, the black swan will change the way you look at the world. And what I actually, Boyke, there's a family of white swans here in East Hampton where I live, and they're so beautiful. They actually have a bunch of little baby swans. But what's important to note here is that the information that you're going to get in today's webinar is sort of the black swan, and or the black swan view of Forex. And the thing here is that this is why I expect it to be met with resistance, because it's going to challenge the way that you look at Forex markets. It is going to challenge the way that you perceive the events that are unfolding. It's going to challenge the way that you translate your fundamental analysis to technicals. It's going to challenge the traditional technical indicators that you've seen time and time again. And it's going to challenge you on a day-to-day basis to second-guess yourself in all of your trading entries and exits. If this webinar does not challenge you to rethink everything that you know, then I certainly hope that you let me know, because if it doesn't challenge you to rethink some of your Forex principles, then I have not done my job well. And I really hope to make that you are able to really start to ask some bigger questions of why. Why do events occur in Forex markets? Why does volatility occur? Why does random volatility push beyond where I always think it's going to push beyond? Why, even when I see the fundamental situation correctly, am I not able to trade the information correctly? Why is it that at an FOMC announcement there is always dual-sided volatility when the end result or the direction that the pair should move is clear? Why is it that that every time that I attempt to take a long or a short against the trend, I'm always just shy of the major reversal point? These are the questions that I hope that you will be asking yourselves at the end of the day today. And it's really, I think, important to back up for a moment that I completely know that everybody here is a very incredible trader, and so I don't want to demean anybody here and lay out a perception that I don't think the world of all of the listeners here, because I know everybody is incredible, but I know that these are yes, I will answer all of these questions, PA, by the time we're done here. And please bear with me, because what and I'm sure what I think most of the people are used to my webinars know is that we start a little bit slow. We start on a conceptual side, and then we'll start to move, and you'll see all this information, as conceptual as it seems, will start to move into the charts, and it will really start to it will really actually, is that a little bit better, Joe? Or Harley, is that a little bit better on a sound level? Can everybody hear me okay? Okay, great. Here, and the reason why I have to move a little bit slower through the conceptual side of it is that really there is a lot of psychology and philosophy behind the true paradigm of trading, and it's more than just technicals, and it's more than just psychology of discipline. It's really a larger philosophical paradigm of understanding why the pairs are moving the way they are. Okay, I'll move the mic a little bit. How's that? Is that good? Too close, too far, too close, too far, too close, too far. Louder. Louder. How's that, everybody? Is that okay? Was okay. Okay, okay. Good? Okay. How about if I do this? How about if I move the mic a little bit and you tell me where to stop it? Good, bad. Stop here, stop closer, closer, closer. Good? Okay. That's good. Everybody can hear me okay? Perfect. And by the way, Eric, I'm glad to see you here. Eric has been with me for a while. I see Eric all the time, and occasionally talk to Eric on the phone from time to time. He's just a heck of a nice guy and a brilliant trader in his own right. And Boyke is always here, by the way. Boyke, you, I think, must have the most incredible repertoire of knowledge, because I see you in the webinars all the time, and if for your effort to never stop learning, I would assume that you are rewarded greatly in your trading. Okay, now we're going to work through these paragraphs here, and please again know that even though that we are no, there's no, actually the mic is not rubbing on the shirt. Are we having some clicking noises still? How's this? Is this good? Yes, it's good. Okay, great. I hate to say this, and this is kind of embarrassing, but I travel quite a bit, but I have a little dog, a Boston Terrier that I love very much, and she actually travels with me everywhere I go. She's probably got 100,000 miles traveled flying this year, and so she's actually laying next to me, and she's sleeping, and she's snoring so loud. I think you might be able to hear that. So hopefully that's not the case. Okay, so we're going to move a little bit slow here in the early part, but this is important, because once we kind of move through a little bit of the philosophical side, you will once we move through the philosophical side, and we start to then move into basically the educational framework, the true science behind the descriptive statistics. Then we'll start to apply that to all the charts. And then what's so great here too is that by the time we kind of get through the first part of this morning here, you're also going to see how the fundamental events line up on the charts, and how the probability of the fundamental event unfolding becomes not only clear and apparent, but we can see where actual probability shifted on the charts, and we can see where the larger mentality of the market began to change. And what this is going to do is this is actually going to give you the ability to take a look at a chart in the future, and you're going to look beyond simple technicals. You're going to see beyond them, much like in the Matrix. The main character, whatever his name is, was able to see the code of the market. But so not only are you going to see beyond the technicals, you are also going to see how the fundamental paradigm is unfolding on the chart, and how the probability within descriptive statistics is displaying that spot on. And so every time that you look at a chart from this day forward, you're going to be able to identify probability. You're going to be able to identify how and where the fundamental paradigm has shifted, and you are also going to be able to see beyond the typical technical paradigm and the simple technical picture. And you're going to be able to use the simple technicals from here on out as a benefit and a additional layer to your trading. And so we are truly going to take all of your knowledge and your trading information and your fundamental analysis, and we're going to take it to the next level. And it doesn't matter whether you've been trading for 2 days or 10 years. Once you'll have this information, you're really there's no reason not to see beyond the typical paradigm. So we're going to just kind of go through this first paragraph, and then we'll dive directly into the descriptive statistics. Okay, at some level, I expect these concepts to be met with some resistance, as traders find difficulty leaving the old concepts behind technical analysis. By this, I mean often when the old way of looking at things is challenged, some may have trouble letting go of the information that has been upheld as true paradigm in the past. However, if we are able to take a moment to step back from the larger concepts of technical and fundamental analysis, we just may very well be able to see that regardless of the action unfolding, at the end of the day, the outcome is nothing more than data. Now, I want to stop right here, and this is where we're going to, this is where it's going to be a little bit slow working through this, but it's important for you to understand what we're looking at and why we're looking at it. And then as we go back in and we talk about the Black Swan, we are going to apply all of this to the actual market, and that's when you're going to see everything transparently. But we have to understand what we're looking at in the first place. And so I'm going to go back to this last sentence. And can everybody see my screen here okay, where my pointer is? And again, this is the second part of the report that you will receive after today, but we're going to work through this today. We're going to put some charts in this today, and that way everybody who's here will be participant to it. You'll be able to recognize it in the future, and when you come back to it, you will be able to go back to each one of these charts and things, saying, oh yeah, I was there for that. I remember that exactly, and that will help, I think, everybody here have the information sink in a little bit more. Okay, so I want to stop on this sentence right here, and I'm actually going to bold this. By the way, I cannot stand the new Microsoft products. Yes, and by the way, actually, for just FYI, the second part, even though you are seeing the first part of the second part, part two, perceiving forex volatility, what we're going to do here is I'm just going through showing you the actual report, and then we're going to go through the conceptual side of it here, and then we're going to go back to part one during the morning webinar to work through the actual explanation of the descriptive statistics. However, as far as when we start to move into with the rest of the information that's actually in this report, when we start to move into the actual indicators that you will find and the actual tradability of the information, that part of the report will be unveiled in the second half of our webinar today. So if you have not signed up for that, please do so. And I really think that the two combined should be pretty incredible. Okay, so let's go back to our sentence here. However, if we are able to take a moment to step back from the larger concepts of technical and fundamental analysis, we just may very well be able to see that regardless of the action unfolding, at the end of the day, the outcome is nothing more than data. Now, I want to take this sentence here, and I want to challenge it for a moment. And here's what's incredible. When I said a few moments ago that I gave you all those questions that I want you to challenge, that you should be challenging about anybody, that I should be challenging, that the questions of the market that we should be challenging, I want to challenge my own rhetoric all day long today, and I want you to challenge my rhetoric too. And so that's what we're going to do right now. We have Harley, I want to point out here something here. Yeah, how you you have to know all of the rules before you can break them. And what you're really getting today is an opportunity to break the rules. And if you don't know those rules, though, how will you ever know where and how to break them? So I can just pull up a few charts and drop a couple of things on if you'd like, but you'll get half the information. So or I can actually walk through all of the philosophy. I can walk through the foundation, and I can walk through the empirical proof of why what you're seeing is what you're seeing, and then we can move to the charts. I did say break rules, Boyke. I said break all the rules. Break the rules of the market. Break not your disciplined trading rules, but the normal conceptual rules of the market. And we're gonna do it. We're gonna break all of the rules. And when you walk away today, you're gonna have quite a bit of new information. Okay. Okay, so here we go. And we're going to focus on this sentence here. The outcome is nothing more than data. Now, let's talk about this sentence for a minute. When we see an event that unfolds, and Harley, just to appease you, Harley, here's a chart for you. Okay, and you see all of these crazy squiggly lines here? And it was in one of the first webinars that I did, that I was actually giving a little bit of information on some of the probability and volatility. The gentleman actually said, that looks like spaghetti. And I guess he was kind of right. It does look like spaghetti. But what you're really seeing here, even though it looks like just a whole jambalaya pie of lines and a bunch of crazy stuff, what really is happening here that you will be able to see and understand by the end of the day today, and there's actually two different sets of charts that you'll see. You will have an understanding of, and these are the actual charts that I use to trade with. Eric, these are the charts that I used to derive the 300 pip winner that you booked. These are the actual, wow, look at that move. That's the reason why I can't pull up the charts, Harley, because if I even start to look at them for a second, you guys are going to lose me while I start trading. Okay. Sorry about moving that around a little bit. Come on. Okay, can everybody see the chart here? You should be looking at the US dollar, Swiss franc. Okay, great. By the way, you'll notice on my chart here, there are two lower indicators that I'm going to use for the duration of the day as well, and we're just going to use these to kind of validate some of our thoughts or not. And one is the CCI, the Commodity Channel Index, and the other one is the will just be stochastics, and I'll go into more why we're using those later on. I would like to note really quick that as far as the CCI goes, has anybody here listened to is it Sam Snead? His I'm not sure if I hope I'm not pronouncing his name incorrectly. Has anybody listened to Sam's webinars? Sam Seiden, that's it. Yeah, Sam is awesome, and from one trader to another. If you have not listened to Sam's webinars, please do so. He is very, very good. And Millward, that's why Sam is good, because Sam gets it. And Sam's been on the floor, he's seen it. And where Sam understands order flow, there's one step beyond that, and that's what you're going to get today. Is Sam understands order flow, and he understands how to see where that order flow shows up, and how to trade where that that order flow actually comes. Bon, that's the weirdest thing. I don't know why you have a clicking or popping background noise, because there's no clicking or popping going on here. Although I do have a it's okay. Okay. What Sam understands order flow, and he I think does an incredible job of helping traders actually see where order flow is transparent. And yeah, am I missing a question here? Actually, I'm more than happy to answer any questions right now. Just to stop here, is there a question that is specifically out there that I missed? Many. Oh, okay. If you've asked a question, can you please retype that question right now, and I will actually cut and paste those in a separate form just so I have them. No, please ask them now. In fact, if anybody has a question, please just start typing them all in right now just so I can get those, and then I will actually cut and paste those in another. I will cut and paste those in another forms and work through them so I don't lose them on the screen here. Sally, I would say that you have to ask, what paradigm are you trading? Are you trading a shorter term scalping paradigm? And how rock solid are your discipline rules? For me, I always prefer fewer lots with more pips, but if you're trading on a short-term basis, you might want to trade with more size with less pips. But of course, the problem is if you don't have rock-solid discipline, if you don't have rock-solid money management skills, and the one time that you break your rules and let a trade go against you, you're going to get smoked. So the bottom line is that we absolutely have to remember that if we're going to trade big size on a short-term basis, we better not break our rules. Common sense fundamental factors for traders. And Jack, we're going to go into that. In fact, I'm just going to highlight your question here, and I guess I can't select the text. I can. Okay, here's what we're going to do. We are going to, everybody has a question, just type your question in, and we're going to put your questions in queue. And then we're going to take your question. Can everybody see my screen here? I just created a Word document. Okay, great. Yeah, and Jack, because we're not getting to the key points here because we're moving so slow. So please just type in your questions at any time. What I'm going to do is I'm going to put everything in queue here, and then this half of the session, I think we're going a little bit longer. Is that correct, Mon? So this will wrap up at 10:45 or 11. Okay, great. What we will do is actually at okay, so this half of the presentation. No, I'm not at all, Rama, but I have to explain the concepts behind it. Okay, so this half of the session will go from 11:30. The second half will start from 11:30 on. Is that correct, Mon? Forward attack! On guard! Okay, here we go. Okay, so let's just jump back here to our question in mind here, and of course, again, like I said, just type in your questions. I'll just put them in my queue, and then we'll go through them all. unless you have a question that specifically applies to what I'm talking about. If it's any bit of a tangent question, just type it in, then I'll go back and readdress it. So what we have here is, and why the descriptive statistics paradigm truly holds true. Truly holds true. That's brilliant grammar. And we're back on the screen here. Can everybody see the screen with the sentence that we just highlighted? However, if we're able to take a moment to step back from the larger concepts of technical and fundamental analysis, we may just very well be able to see that regardless of the action unfolding, at the end of the day, the outcome is nothing more than data. Okay, so as we go back to our chart here and we look at the chart, this is where I hope to begin challenging the way that you look at markets. What we're seeing here is it doesn't matter if I go down to the 1 minute time frame. The data that I have here, and you see this apparently on my tick chart. For every time a tick occurs, it is a mark of data. That mark of data displays here. We have one 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 here. That data is in here. That data is in here creating this bar. We have data here in this bar. We have the data shows us that while in this 1 minute period we traded as low as one spot 1015, we also traded up off of the low towards the close on a 1 minute basis. The paradigm shift here, the part where I want you to stop and challenge what you're looking at, challenge why it even exists in the first place, is remember, regardless of the unfolding of the action unfolding, at the end of the day, the outcome is nothing more than data. And so by that I mean when we actually look at what's happening on the chart here, that regardless of what happened here in this period on this chart, the larger outcome, the final outcome that we're truly looking at is nothing more than recorded data. The data is displayed in the ticks that make up the minutes, that make up the 5 minutes, that make up the 15 minutes, that make up the 30 minutes, which make up the hour, which make up the 4 hour. This is nothing more than the visual representation of the actual data. And the data itself is nothing more than the representation of the action or the larger market fundamental and or technical mindset that was apparent at that particular time. And so when I look at this 4-hour chart of the US dollar Swiss franc, we took our short position right here on this bar. Is that right, Eric? I think that's right. Actually, I'm sorry, we took our short position right in this area, I believe, right here. We rode a slight bit of volatility upwards, and then we took out all of this on the downside. And we were able to do that because we were able to ride through this little hump of volatility to take this massive 300 pip pointer out over the last 3 days, because we understand not only volatility, and we understand that this was not the true paradigm of the market, this little rally right here, but we also were able to identify that entry because regardless of this outcome, regardless of this 300 point sell-off, is really what we have here is just an outcome. This is just data. It is the visual representation of the trading action that has unfolded directly in front of our eyes. So what we have here then we will move directly into part 1 of our report. We are can everybody see part 1 okay here? Okay, great. Um, the data that we're looking at, and I know that this is frustrating for a few of you because I know that we're moving slow, and I'm intentionally moving slow because it's so important to understand this side. It's important to understand that we're not just looking at a chart and looking for two lines to cross over one another. We want to understand exactly what is truly happening within the forex market. If we really want to be Neo, if we really want to be able to read the code behind the market, then we have to be able to know that code in the first place. We can't break the rules unless we know them. And if we don't understand the data that we're seeing, if we've never actually taken the time to truly challenge why it even exists in the first place, then how the heck would we ever expect to change it in the future? And so that's what drops us directly into the descriptive statistics paradigm. And just out of curiosity here, and I'd like as much feedback as possible here. What is everybody's impression here of descriptive statistics? What are they for? And have you used them in the past? And what have do you see any benefit whatsoever in descriptive statistics? And please pile in all of Rama. All of this is going to come out very, very, very clear here in a few moments. By the way, and Rama, you think descriptive statistics are yeah, Sally. Okay, I'm going to log your question here, Sally. Sally, that was an incredible question that I really, really appreciate because Sally, that means that Sally, you're on it. You get it, and I that's awesome. So I'm just going to log your question, Sally. Okay, thanks for that mod, by the way. Very confusing. Peter, see benefit for trading, Forex champion, volatility of the data. And Millward, does it mean the past results of data analyzed? No. Um, yes, it does. But let's think about this for a minute, Millward. And this is where this is why I have to move so slow through this very first part and through the conceptual framework of it, is because this is such a big paradigm shift that I know that most people in the market are not used to looking at and even perceiving the market in this mindset. And first and foremost, statistics is a very dirty word, and it's a very scary word. And for most of us, anytime we say statistics, we think we're going to do a bunch of math. We think it's going to be slow, and we think that it is also going to be very, very tedious. And Ed, exactly, inferential statistics. By the end of today, that you are going to be able to visually identify descriptive statistics on the chart. You are going to be able to actually lay in indicators that will do the work for you, and you will see that you will be analyzing the data on the chart in a descriptive statistic manner using the indicators that you've used all along. You just had no idea how powerful they were. And so what we have here as far as statistics go, where Forex Champion, you said, because I think this is really, really, really great here, you said volatility of data. Well, yes, statistics are about volatility of data, but even more so, statistics are about just analyzing a period of time to understand where that data and why that data surfaced in that period of time to infer what could happen in the future. And when we completely understand, yeah, absolutely, Rama. And by the way, no, as you're going to see, that we are not going to overanalyze a pattern. And actually, if anything, the descriptive statistic paradigm actually helps you clear the analysis paralysis and helps you clear away over analyzing typical technical indicators. So what we know here is that when we look at the data, we look at the data in the case of if I'm going to do anything, if I'm going to use a 20-period moving average. And you can see right here on this little chart, I have added in 2 moving averages just for you to see. And what we have here is we have a 50-period exponential moving average based on a low. And please know that I'm only using this moving average as an example. I also have a 50-period exponential moving average as a high. And these moving averages, the low and the high moving averages, are, I know many traders use them simply to be able to identify larger movements and larger directions of trending. But let's analyze what's happening here. If I look at the moving average within itself, and I know that if it's a 50-period moving average, it is going to analyze 1, 2, 3, 4, 5, going back 50 days. So I'm going to have roughly just under, if we were looking at the daily chart, just over 2 months worth of data. And so what I'm doing is that by using these moving averages here, I'm essentially attempting to identify a mean trading range based on those 50 days of data recorded. And so to understand that, if we take our actual bars here and we look at that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. So we know that this is about 25, and so our other 25th bar is probably right here. And so we know that in this 50 days, where do you suppose the mean of that 50 days is? Middle of the road, you know it. Okay, now let me ask you another question. Why would the mean even be important? Why would we even care about the mean? Why would it even make a difference? Has anybody here ever heard the term VWAP? The amazing and brilliant and incredible VWAP? Bueller? VWAP. VWAP stands for volume weighted average price. And the VWAP is where you find institutional order flow. Institutions, major funds, major huge billion-dollar traders, they when they call in an order, to the order flow desk, they say, give me if I'm a huge trader and I trade for the sovereign fund of China, and I decide that the euro is going to decline and the US dollar is going to increase, and I make that decision because we have failed ascending support on the longer term chart, and I make that decision because I perceive that GDP will eventually recover in the United States, and because liquidity has been clipped in the euro area on a fundamental basis, because interest rates are 4.25%. When I make that decision that it is time for a larger shift in the euro-US dollar, and it's time for the euro to actually lose ground and the US dollar strength, what I do is I'm going to call in my order, and I'm going to call in my order to the order flow desk or to the trading floor. And when I call in that order, and assuming, I'm a billion-dollar trader, and I'm not just Joe retail trader that's trading at FXCM or Forex.com who is trading, maybe on the high end, $2 or $3 million fully leveraged. I'm actually putting to work $5 billion, and I'm going to leverage that money out. and I'm going to leverage it out 50 to 1. And I'm gonna put together a series of orders and order flow over the next 3 weeks. But today, right here, right now, I want to put $1 billion into the market. And I think this larger fundamental paradigm shift is about to occur. So I call my trader and I say, trader, why don't you pick me up $1 billion of that euro US dollar, and why don't you get me that at VWAP or 10 pips, or VWAP at 10 pips or better. And here's why we have to understand descriptive statistics and why we have to understand the mean. Because volume-weighted average price is what institutional people use to basically to ensure that they're getting a good fill from the huge from the floor traders of the world, and that's how the trading houses make their money, because the biggest funds in the world trade with the traders who can get the best prices on the day in regard to the VWAP. And the VWAP is the volume weighted. I'm going to pull it up for you here. The VWAP, can everybody see my screen okay? It's sized okay? The trading benchmark used especially in pension plans. VWAP is calculated, oh boy, these little pop-up ads drive me nuts. The VWAP is calculated by adding up the dollars traded for every transaction, price multiplied by number of shares traded, and then dividing by the total shares traded on the day. And so what we have here in the case of Forex, and you can see, I'll move back over to my other chart here. VWAP is not a term that you'll hear from many retail traders. VWAP is not a term that many retail traders know. VWAP is a term that every institutional trader knows. VWAP is a term that every floor trader knows. When you are a billion-dollar fund trader and you are going to utilize third-party trading for your executions or your order flow, you are always going to request a price better than VWAP, because if you have a price better than VWAP, you know that you got a good fill on the day, and likely you're going to go home for the day in the black. And here's what's so important. With the rise of computers, not only, it used to be you would call your floor trader and say, get me XX, plus or minus VWAP. And the traders who could get the best fills in terms of VWAP, the traders who were the best traders, had the most business from the big institutions. Well, there's something else actually happening now. There's algorithmic order flow. And when the major houses of the world, all of them, Merrill Lynch, Goldman, all of the major currency houses, and also many third-party quant firms are constantly coding and renovating algorithmic order flow execution systems that actually place the trades for these institutional guys, ensuring them prices that are better than VWAP. And what this means is if we look at the volume weighted average price, and it's gonna, so for on the day, and I'll tell you this one concept, VWAP alone, once you get this, you're gonna be so far ahead of so many people, because it just is one of those things that I don't know why many people don't know it, but maybe just because they haven't been on an institutional desk. But it's without knowing this, it's like trading with half of the information. Okay, we're back on our chart here. If I look at the chart here, what the VWAP does, it's a volume weighted average price, so it resets itself every single day. And we'll go back to that equation that I showed you a few moments ago, and you can actually probably, I think there's probably a MetaTrader VWAP um, indicator. I just haven't looked for it. Maybe I'll do that in a few moments if we have a second while we're actually just chatting or answering questions. But what the VWAP does is actually will reset itself every day. And so as the volume surges and the price surges, of course volume will move up, and of course if volume decreases and we see a significant price up, the volume weighted average price will not actually move up as quickly. And so what we have here is we have a volume weighted average price. So if I could take the sum of all of the data from the day today, I could take the sum of all of the data today and actually get a. And I'm just going to come back over here to my other chart here because. Oh, really? You didn't see a VWAP indicator? Huh. You know what I'll do maybe tonight, Polly, if there's not one out there, maybe what I'll do is I'll actually try and write one. So the only issue is that, and the reason why the typical VWAP indicator probably is not out there is because what we do is we do see volume, but we do not see. And bear with me, I have to switch over to my other screen here as we get back. I can't believe you guys don't know VWAP. Shocked. I mean VWAP is it is the reason volatility shows up. It is the reason intraday volatility kills so many people, because as you're about to see, the institutional traders, they trade on VWAP. Okay, I'm just pulling up this. Yeah, Rama, total volume of FX trades are not revealed, and so there is a bit of the printless market that we don't know. So, but we do have some volume indicators. So we have basically we know that VWAP is the number of shares bought times the share price plus the total shares bought. So basically what happens here, because we can't actually say the specific within Forex, we can't actually say the specific shares that are traded at any particular point in time. Meaning I can't actually, in equity markets, when I was a market maker, we used to do a thing called that we would put shares up on the cross at the top of the hour. And we would do this via Instinet. And it does, but Voike, I'm going to show you how the VWAP equation applies to Forex here in just a moment. But we would, when I was an equity market maker, it's way back in the day, back when Soros systems were still around. But we would put orders up on or flow on the top of the cross. What that would mean was at 3 minutes to the top of the hour on Instinet, this is back when we had an old analog Instinet machine, we would actually put in our order on Instinet, and I would go to Instinet, and I would say I have, and this is usually just in an illiquid stock, I would say I have 200,000 shares of stock XYZ that I need to sell. Well, I couldn't put in a price because this is what the on the cross function was for. And then maybe say Joe in Albuquerque, he's got 100,000 shares to buy, and it's an illiquid stock. So he would go to Instinet 3 minutes before the hour, and he'd say, I've got 100,000 shares to buy, and he would put that in. Well, exactly at the top of the hour, Instinet would cross our orders, and whatever the market price was exactly at that time, we would both get that fill. And so you knew if there were big on the cross orders, if you started to see illiquid stocks start to move 10 minutes before the hour, because you knew that the market makers couldn't get out of their position, and they were basically they'd put a lot of size up on Instinet to cross over the top of the hour, and they were trying to move the market in their direction of a better fill. Well, we couldn't pick our price. And so, and the same thing kind of happens within Forex, in the sense that, as far as the VWAP equation goes, we can't pick the specific price that each one of these of like if I see all of this daily data here, I can't. Unlike equity markets, I can't tell you. Okay, there was exactly 5 million contracts traded at price XYZ. But what I can do, and this is actually a whole other special report on VWAP and actually just coding the equation, but I would be happy to write one of those for MetaTraders and provide it to you. It would probably take me a week and a half, 2 weeks to get that coded and done, but it would be of great interest to many people here, and also I will compile a report on VWAP as well. But what we can say is just through MetaTrader, just using MetaTrader's data alone, that we can use MetaTrader's inference of volume on a 1-minute chart and basically have an average of an average price on a 1-minute basis and multiplied by the time of volume that they have here. And so it does. Actually, the CCI indicator does not replace VWAP. Because what the actual, yeah, you bet. Actually, that'd be kind of cool, I guess. You could call it the, I don't know, maybe what. Anyway, oh, great. So it is actually out there, numeric. See, here's the thing with I mean, I want to show you the VWAP specifically, but the thing is, the reason why I don't even have it on my screen is because with descriptive statistics, I know where it is anyway, and you're going to know too, and that's what I mean by you're going to be able to see more than just the market. You're going to be able to see the code behind the market. But when you understand where VWAP is, you know where institutional order flow is at or must be, and that's the most amazing part is that. If a forex pair on a day is trading above VWAP and I'm fund XYZ and I call my floor and I say, hey, Joe, I want to buy $5 billion of euro US dollar, but right now we're trading above VWAP. Why don't you get me VWAP or better? What do you think that floor trader is going to do? He's gonna wait till the most illiquid moment in the market, and he's gonna pop in a pile of trades just to drive the euro down below VWAP, and then creating all of a sudden a bunch of volume, and then he's gonna get the other side of the trade, and he's gonna fill that order, and they get paid on it. And not only is he gonna make money on the short side, driving the actual pair below VWAP, but then he's gonna buy that guy below VWAP, and he's gonna make all of the money on the execution cost too. So what we really have here is a larger paradigm of institutional order flow that is derived from the VWAP. But we don't even need the VWAP because what we can do is we can use simple descriptive statistics to understand where those outliers of volatility will be. Because if we know where those outliers of volatility are on any given time frame, and specifically even on an intraday basis, then we know that those floor traders that when they start to get these huge, massive orders that have to be VWAP or better, well, that's why you get these jiggity-jag movements that jump all over the place. Because I guarantee when we were up here, VWAP was here, and when we were down here, VWAP was here, and when we were up here, VWAP was here, and when we were down here, VWAP was here. And so when we start to actually see periods where we're not trending and we're trading laterally, you're going to see traders get yanked all over the place as order flow constantly comes to and from VWAP, to and from the median, and we constantly see that mean reversion and that mean reversal because there's no true identification of trending, and so there's no reason for institutions to take on any additional risk and buy or sell beyond VWAP. And if they do not go home better than VWAP on the day, if they've taken that position, then they're just a bad trader. And so if we understand the concept of institutional order flow and how these guys think in the first place, and then apply that to the market via descriptive statistics, we actually have the ability to not only trade like a fund or like an FX reserve, but we also have the ability to actually to perceive their thinking before it ever even shows up. And then on top of that, with the descriptive statistic paradigm that you're going to learn more about today, when we understand these parameters of volatility, it also stops us from taking a position on or taking a trade on the wrong side when momentum and order flow is truly working against us. And again, Sam, and I can't remember his last name. Sam Seiden. So what you're getting here is Sam gives you the how do I see how do I see order flow? How do I trade? How do I not get in the way of order flow? What you're getting here is you're getting the why order flow shows up and why it shows up at certain points, why it shows up at places where why it actually will continue to trend and not, which you'll see. Excuse me, I'm just reading your comments here. Okay. I still call in some of my orders, bigger ones. Okay, what we have here is in the larger. Okay, Mod, gotcha. In the larger paradigm here of descriptive statistics, what I really the entire point here is with the till now heard. I'm not sure if I understand your question, Emru. I don't even get a pip of a clue how to improve my trading with the till now heard. Okay, what we're going to do under a normal Gaussian curve, if you've read the, it should actually it'll come clear here in the next 15 minutes, Emru, and what you're going to see is you're going to see how to infer that VWAP in the institutional trading. And no, VWAP is an intraday item. It is something that institutions use to get a good fill. And VWAP is the volume weighted average price. If I'm a huge fund and I do a ton of trading and I'm going to take a massive position, I'm not going to pay attention to technicals. I don't care about where MACD is. I don't care about stochastics. I don't care about any of that. All I want is I want to take a position because I think the larger fundamental paradigm is changing. And I believe that it is a good entry point for me to capitalize not only on the capital, there's that word capital twice, but I want to profit from the capital appreciation of my trade, and I also want to capitalize on the interest rate differential, and I want to capitalize on the carry trade. So what I'm going to do is I'm going to call in my order, and I'm going to say I want VWAP or better. Well, VWAP is an intraday item. It is a volume weighted price on an intraday basis. And so as an institutional trader, as a large fund, I don't care about this intraday movement here, up, down. I don't really care about that because I want to hold my position for the long haul, for the trending. I want this big move. I want this big move. I'm not a guy who's here for 15 minutes, and if I'm an FX reserve, I'm not going to be in the market for 2 days. I want to catch the wave of a position for a long-term trade. And those positions are only derived through fundamental analysis. Well, when I enter that position, when I determine that the market is overbought or oversold to a point that my risk reward is acceptable, then I'm not going to go in on an intraday basis and bang my head against the wall. What I'm going to do is I'm going to call the floor and I'm just going to say I want VWAP or better. I want the day's volume weighted average price or better, and I don't care if that's by 10 pips. But that way, at least I know that when I traded $2 billion, when I bought $2 billion of the euro US dollar on this day right here, I didn't get the high and I didn't get the low. And my $2 billion is filled at the volume weighted average price. So I know that I got kind of the mean of that day's fill to be able to hold that position over the few short following days to ensure that I'm not going to get completely smoked, and then from there hold that position for a long term haul. And yes, absolutely, Rama, that is the point of the true paradigm behind Forex, and why the small FX trader constantly gets smoked, because the small FX trader doesn't understand VWAP, and the smaller FX trader doesn't understand why currency trend at all in the first place. And the reason why they trend, I'm going to move over to my screen here, is because of the formula, and the formula is right here. And this slide is actually on FX Street. You'll find it in my presentation on the correlation of oil and the US dollar. And this is the true formula behind Forex right here. Anytime that interest rates go up, you know that generally that currency is going to go up. Well, interest rates are derived from rising inflation and rising GDP. If GDP increases, you can pretty much bet that interest rates are eventually going to go up, and if interest rates are going to go up, that currency is going to go up. Well, also, if inflation, as we saw with the ECB in June, or excuse me, in July, even though GDP wasn't increasing for the euro area, inflation, short-term inflation, was so high that the ECB raised interest rates to 4.25%. And what happened running into that scenario of the ECB raising interest rates a quarter point? The currency went up. And that's just the general fundamental sense behind the carry trade. If any time I can get paid to hold a currency instead of paying money to hold a currency, you can bet I'm probably going to try and buy that currency I get paid for more often than I'm going to buy the currency that I have to pay to hold. And so that's why you see the reversal in the US dollar, in the euro US dollar right now, is because there's a lot of question in the market on whether the current interest rate differential will hold or not. And the interest rate differential is 2.25%, where you have the euro area actually yielding 4.25, the FOMC 2%, and so it pays 2.25% to hold the euro. And if we go back to our chart here, we see specifically just on the monthly chart, we know from February, October, June, and all the way up into July, that while that interest rate differential kept expanding because the FOMC was lowering interest rates and ECB was raising interest rates, the interest rate differential was expanding, so it paid to be long the euro, and that's why we get this massive upward trend here. Well, when I am an institutional guy and I see that, I perceive that fundamental event occurring before it happened, I know that the ECB is going to hold rates steady and the United States economy is in so much trouble they're going to have to lower rates. Well, I want to buy the euro to be in for that interest rate carry trade. And so that's when I'm going to call my floor trader and I'm going to say, hey, look, on this day, get me $2 billion at VWAP or better. And it's the institutional trader's job to get him that fill on an intraday basis using VWAP at the average price. Because if I'm that funded, I'm putting $2 billion to work, and he fills my entire $2 billion up here, and then I go home that night and I'm already down $3 million, I'm going to be a little pissed off at that institutional trader, that floor trader, for getting me such a cruddy fill. And so what I'm going to do is I'm going to tell that trader, look, I need VWAP or better, and that means he's going to have to get me this median price right here. And so that's why you see on an intraday basis these prices yank all up and down, up and down. It's because all of the floor traders and the institutional guys in the world are ensuring that when they take bigger positions on any type of a fundamental scenario, they have to get VWAP at least, or pretty darn close to VWAP. And so we can measure that through the descriptive statistics by simply overlaying Bollinger Bands and also through moving averages. And of course, I will get the actual VWAP indicator from MetaTrader here that you guys can use. But yes, and absolutely, and I'm going to show you here, Rama, in part 2. That's what part 2 is all about. Part two is actually taking all of this information and understanding why. What part one here was geared to understand why the descriptive statistic paradigm exists at all, and why descriptive statistics will constantly alert us to when trending and reversal will ever show up, but even more so, why the mean reversion scenario occurs time and time again in Forex, and why we see this crazy intraday volatility all over the place. Why we see all of a sudden today in the euro US dollar, the euro runs up here all the way up to one spot 4515, and these guys who the breakout traders who are up here, the technical traders, they bought up here, and all of a sudden the euro comes all the way back in, and the guys who are trading just on technicals are going, what just happened? Why didn't the momentum keep going? Why did the technicals fail? And the technicals failed because the institutional orders, the institutional order flow demands that on a daily basis that the euro US dollar come back to revert to the mean in order to allow for larger order flow at or near VWAP. And so when we start to think like an institution, when we start to understand that this volatility is created because of institutional order flow and because of the manipulation of floor traders to get more institutional order flow, then we start to not only see beyond the simple technical indicators, but we also understand that there is a fundamental paradigm occurring here too, where a larger firm or a larger fund is where they will and won't take positions. And Forex Champion, I'm going to show you all of that in part two, and that's where the actual application of the indicators unfolds, and where the actual application of understanding how and why we can use some technical indicators here and actually apply the descriptive statistics through the simple use of Bollinger Bands to identify when the VWAP is going to start moving up or down. Not only that, when the fundamental paradigm is shifting, and also when and how we can perceive the institutional order flow before it shows up. But even more so, when we use descriptive statistics to be able to measure via a Gaussian curve the actual range on any particular day, because we know, if you, as in part one, that everybody here has read, that if we can find a mean on an intraday basis or even on a long-term basis, and we know that it's going on one standard deviation on either side of the mean, we know that 68% of the data has got to be, and I'll just show you what the actual application is here, because is that if I am actually looking at this in terms of a descriptive statistics normal curve basis, I know, and I'm just going to, okay, you guys, I need to wrap up here, and we'll get ready to move into part two. But just to briefly in 90 seconds to wrap up part one on the chart and to explain why this is so important and why it's so important on your charting level, and what you're about to see in part two is that I know on a descriptive statistic basis, if I can measure the mean, then through descriptive statistics, I can measure the volatility, and I know where the outliers of volatility are. And so when we start to rally, I know when we are at an extreme point of volatility that we have to revert to the mean, and I know institutional order flow is looking for the same thing. And I also know when to look for further trending, because we are trading on one side of the mean. And notice that this is just a rough example of a Gaussian curve here, and we have the mean, one standard deviation, two standard deviations, three standard deviations. We have the mean, one standard deviation, two standard deviations, three standard deviations. And so well, not always, Millward, and that's also what you're going to see in part two, because in the case of a larger fundamental shift, the VWAP can trend all day and close at a high or a low, because it means that the institutional guys are basically pushing the VWAP in one direction or another. And by that I mean, if we look at this day's data, we know that the VWAP, while the VWAP was probably right, it closed in in the middle of our range right here, that because of the larger just ascending trend of the day, we know that the VWAP and the actual institutional order flow, based on the skewedness of the data to the left side of the mean, indicates further trending to come, and the reversal is not here yet. And with that information, you would have been able to get long the euro as we entered this portion of our trending. And it wasn't until we reverted back across the mean, which the descriptive statistics will show you, that you will not only be able to identify but trade the reversal as well. So you're trading like an institution. You're looking beyond technical indicators, simple technical indicators like MACD, and really you're seeing institutional order flow, you're perceiving institutional order flow before it appears, and you're also trading with the true fundamental economic paradigm in your corner, and you are boldly seeing all of the true code behind the market. And this is to go back to your question a long time ago, Harley. Harley, when you said, why can't we just go to the charts? Because without understanding the conceptual framework of why this exists at all, I can explain it to you, and it wouldn't even matter. Because if we don't understand the concept of why it exists in the first place, it wouldn't, having the information wouldn't help you anyway. So that's why in this half of the webinar we had to just focus on the the paradigm, the true concept. So anyway, I need to wrap up right now, and I will see you guys. Maud, what time are we back for part 2? At 11:15? Okay, great. And okay, we're back at 11, so we'll be back shortly. And just for everybody here, please be aware that I will be posting. I will find some code for the VWAP, and I'll also write a report on VWAP and get that to FX Street. It'll take me a week and a half, 2 weeks to get that done. But please expect that coming in the future, and that I think will be significant. And I look forward to seeing everybody in just a minute. Thank you so much.